Hi, good morning, and welcome to our weekly market brief with Morton Brown Family Wealth. I am Katie Brown, and I have Cody Demmel here with me today. Hi, Cody.
How are you?
Good, good. So this is the week of June 22nd. We are officially in summer, so hey, happy summer to everybody. Well, just really quickly before we kind of, hop into some market conversation here. Cody, what are you doing with your extra sunshine during the day? We have these long days.
On Tuesday and Thursday, I'm playing soccer, so that takes up a lot of my day after work. And the extra days, just hanging out with Courtney and the dogs. How about you?
Nice. Yeah, I'd say similar. A lot of soccer, a lot of tennis, and it's nice to be outside late. I think we were out on the fields, after 8 o'clock last night. So it was really great to get out there and get the vitamin D in. So I hope everybody else is able to get out and enjoy some of the sunshine too. So today, and the whole purpose of these market briefs are really for us to help answer some questions that we might be receiving from clients or people that we're speaking with, in the midst of this market volatility, this active year that we have going on here. So I do encourage everybody to post questions into the chat. This is your time. And if anything's, kind of top of mind that you're wondering about, thinking about, that we may be able to kind of dive into a little bit for you, we are happy to do that. So please utilize the chat. Otherwise, Cody and I, we have a few things that we've been talking about within the office and some items that we'd like to pull forward and just kind of give some perspective around. A couple of things on our list for today. Gas prices, we're all feeling that. We'll talk a little bit about inflation and the increase in the federal funds rate and how those kind of move in tandem, but maybe don't. And then also, what type of bear market are we in? We have a really great piece from our friends at Goldman Sachs that kind of breaks that open a little bit into different types of bear markets. So thought we'd touch on that for a little bit this morning. As I mentioned, if there's anything else that people would like to talk about, please feel free to post that. So before we kind of dive in, Cody, why don't you give us maybe an update as far as where we're at right now across the equity markets and bond markets?
Yep. So far year to date, we're down around 20% in the S&P 500. The Nasdaq, which is the tech stocks, has been hit a little harder with the growth side of things have been hit, and on the fixed income side, so the bond side has actually been hit a little hard this year too, with starting from low interest rates, and with the rise in interest rates, the bond prices have been down a little bit. So the fixed income side of things have been hit a little hard this year too.
Yeah. We were talking about this earlier, kind of the 60-40 portfolio. So 60-40 portfolio being 60% stocks, 40% bonds, considered to be a balanced, fairly prudent portfolio that allows some room for growth within the stocks, but stability within the bonds. And that has been something around that range, has been a widely used strategy. But there's been a lot of questions, especially this year. Does that 60-40 portfolio still make sense? Or has that fallen by the wayside? What are your thoughts on that?
Yeah, I think it still makes sense, and especially as the yields of the fixed income start to rise, then we can actually get some returns from the fixed income side. Where over the past couple of years, the returns that we got from the fixed income was because we were in such low yield years that the bond prices started to rise. But now, as we go the opposite way, where we can actually get some yield from the fixed income, we can actually get some dividends, some actual income from the fixed income. They're able to keep their stability, hopefully, going forward from the fixed income side. And stocks are always going to be up and down. I mean, that's how stocks obviously make their return. That 1 year up 20%, 1 year down 20%. They're going to be volatile. So,
you touched on something in there when you talked about returns that people receive. They really receive it in two places or two areas. It's the change in the price of the underlying holding, and then there's the interest and dividends. And typically that dividend and interest income that you receive on bonds or companies paying out dividends, that's usually considered the safer income. That's typically protected more so than the changes in prices. So you brought up something interesting there. On bonds, we've been really relying on the price appreciation, not the income appreciation, but we're in the process of making that switch over.
Yeah, yeah. Because before the last, like the 5 years where we're at right now, have been just the price appreciation because we've been at such low yields. But before that, it was the yield we were able to get from the bonds to make up for any price or depreciation we saw on the bond. So it's a switch over, as you were saying. Now that we're going from such a low yield, now we actually hopefully get some yield from the bonds going forward.
Yeah. So for conservative investors, this is actually it's a difficult churn, but it's probably a better end state
Yeah,
once things kind of normalize a little bit.
yeah,
Um, I think our friends at East Bay, or our team, I should say, our strategist team at East Bay Investment Solutions has also really accurately pointed out that a lot of the volatility this year started on the bond markets. So it was not and so the sell off in both bonds and stocks, it's not that the bonds were reacting to the stocks. It's that a lot of this churn started by those increases in the interest rates, which bring down the prices in bonds.
yeah,
And so bonds are reacting in some respects different from what we're used to, but it makes sense, their reaction this year. And on a relative basis, they are still providing more stability than the stocks are, which is what we expect from bonds. And so even though they're, selling off in the 8 to 10% range on the U.S. aggregate market, it's still better than the 20 plus range that we're seeing in the stock market.
yeah.
Yeah. And how about something else that we've kind of talked through, and just wanted to see, something else that we have kind of talked through a little bit, like PE ratios. That's something that we, in our last 3 or 4 commentaries, we've been kind of putting out the little like cautionary light saying, okay, price to earnings ratios are creeping up, and at some point that has to normalize. So they could be sustained if we have earnings that are keeping pace with the price. Like that's one way they can come up, or the prices have to come down. And I think we're starting to see those prices coming down. I was looking at a chart the other day that had, the average PE ratios before coming into this year were right around 23. Now that's come down to 17 and change, which is very close to the historical averages. And so I think a lot of this continues to be a resetting, or sort of getting back to the averages, the normalization, and really, cutting out some of the fluff, the froth
Yeah.
we were seeing at the top.
Yeah, they assume that as the Fed starts rising the interest rates, that the growth of these stocks or of these companies are going to start slowing down. So once that starts slowing down, if their earnings still come above where they're expecting, we could see a rise in the stocks. But they, as you said, the earnings went from 23 to 17. So they're assuming that things are going to start slowing down. And if we still see a strong economy going forward, we could have a bounce back from here.
Mm-hmm. Mm-hmm. All right, where do you want to go from here? We could talk about the bears, or we could go into the federal funds rate and inflation. What do you think?
We can either or. Where do you want to?
Okay, let's touch on inflation. We're all feeling that every day. Let's touch on inflation and gas prices here. So actually, I'll let you kind of walk us through this chart a little bit, if you don't mind.
Okay. So the purple line is the Fed fund rate. So they raise this line when they think we have high inflation, and this goes back to 1960 to today. So they start raising the fund rates when they think we're going to have higher inflation, and the orange is the inflation number. So you see, in the past, they tried to keep up with inflation, or rose the Fed funds rate right around the inflation number.
Mhm.
Recently, they're lagging behind a little bit, but you can see that the tick up here in the fund rates, because they're trying to slow down this higher inflation number that we've seen recently. Um, and if you look at the average over the past 60 years, the orange line, which is the inflation number, you can see we have really high numbers and then below average numbers. So it's either really high or really low. And we see now it's obviously really high, and everybody feels that. But hopefully over the next couple months or next year, this will drop down lower and we'll get back to normal.
And I think that's still the expectation, that that gap there, like that gap is not typically sustained for a period of time. There's there's a period of time here where once again it is normalizing, and it'll need to kind of find its way back to a tighter range there. But we can absolutely see, and we all feel it, that gap there between the federal funds rate and the inflation. And just a reminder for everybody, that federal funds rate, that's the rate that the Federal Reserve sets. That's the overnight lending rate for the banks. And just to kind of talk about the Federal Reserve for a minute, I mean, they have two main mandates. One of them is to, set the rates to kind of keep inflation in check, to have stable pricing throughout the economy. And then the other thing is jobs, and to make sure that we have sufficient employment across our country and our nation. And that's something we haven't talked about too much recently, but our unemployment rates continue to be very, very low. We continue to have more jobs available than people see, looking for them. I think our unemployment rate sitting around 3.9% in that ballpark right now, which is still very historically low. And I think we haven't been talking about that quite as much because that's often a lagging indicator. But looking here on the other side of the Federal Reserve's mandate, this is where for a long time, and we can see that, that federal funds rate was sitting at zero, near zero. And so they are starting to hike it back up. We just had a 75 basis point increase, discussion about another potential 75 basis point increase. And this is a time when I don't envy Jerome Powell trying to figure out how quickly to raise those rates, because he's starting from the bottom. There's some catch up that needs to be done, and we're all feeling that effort of that catch up right now. And I don't know what the exact solution is. Maybe we can move at a little bit of a slower pace, increasing the rates. That may be helpful. But he said that the goal here is to kind of tamp down that inflation, slow things down, but then we feel it in the bear market, potential recession. We don't know. So
yeah, that's a tough thing, that they're trying to raise it without slowing down the economy too much, where we get into the recession. They're trying to slow it down at the perfect spot, so we continue growing, but slow it down before the recession. So they obviously have a very tough position that they're in right now.
Yeah. And one of the biggest areas that everybody's feeling is, gas prices. So still sitting around $5 average. They might have ticked down just slightly. Really quick anecdote. This past weekend, my family and I, we went up to Rhode Island to visit my in-laws. And at some point, driving somewhere around the Rhode Island, Connecticut border, somewhere in there, I could see, we're on the highway, and I could see a gas sign that was like 471, and that's the lowest that I've seen in a really long time. And there was like this little piece of me that thought, all right, I'm going to go over there and get that gas. It was probably miles away. I would negate any savings, getting over there. But then I had like the realization, like, okay, I have turned into my father.
my grandpa is still like, he always is like, okay, this gas unit is like 471. This gas station is like 485. It's like, you're gonna drive that much farther to save. It's not good. It doesn't work out like that.
I know. But Do you want to talk about the recent conversation?
Yeah, yeah. So the Biden administration now is thinking about delaying or yeah, delaying the gas tax that they have right now. So it'll save potentially 18 cents per gallon of gas that they're thinking of delaying it for 3 4 months,
Mhm.
which would obviously help before they get the supply chains hopefully get the gas rolling again. So that would help hopefully.
Yeah, yeah. I think in really encouraging the states to follow suit as
Yeah,
well.
yeah,
They just kind of put a pause, a temporary pause on those gas taxes,
yeah,
to try to help alleviate a little bit. I mean, it's going to be an expensive summer. It's going to be an expensive summer from obviously a travel standpoint, but also we're still in the midst of people getting caught up on vacations.
yeah.
Vacations that were planned over the last couple of years that have been pushed forward, pushed forward, pushed forward. I know everybody I'm talking to has something on the calendar that they're looking forward to. So it's, and unfortunately, there's another line item or an increased line item now to make that happen.
Yeah.
All right. And then finally, let's talk about our friends over at Goldman Sachs sent over a really interesting study on bear markets. And they broke it down. They looked at, bear markets, I think 29 of them going back to the late 1800s. And they broke them kind of into like three different categories. So they had the structural bear markets, cyclical bear markets, and event driven bear markets. So just to kind of pause on those for a minute, the structural bear markets are things where there are, imbalances within the economy. Things like the financial bubble. So if you think about the dot-com bubble or even the financial crisis, there's a it's something that is and it's interesting because it's not only that there's a bubble, but there's that like incredible euphoria that goes with it too, where everybody thinks, all right, everything's great, we're going to keep charging ahead, but really there's a lot of structural issues underneath it. And those tend to be the hardest bear markets to recover from. Will often, lead into recessions, but those tend to be the longest and take the most amount of time to recover. And then they have the cyclical bear markets. And the cyclical bear markets are more of a function of rising interest rates, and then lower profits from companies. So we're kind of, slowing everything down, kind of squashing that down. And that's the most common. So if we look at those almost 30 bear markets going back to the end of the 1800s, somewhere around, seven of them are structural, somewhere around seven or eight of them are event driven, and then the vast majority are cyclical. They happen over time, and it's necessary to once again kind of wash out that risk and make sure that we're not leading to a point of a structural. Like I think the cyclical bear markets can actually help us make sure that we don't fall into a structural bear market, which would be worse. And then we have the event driven markets. And Cody, if you want to kind of talk about that and give some examples there.
Yep. So event driven is obviously major events that we've had, whether it's going back to the 1800s, World War One, World War Two, and then obviously recently the pandemic. We dropped down 30%. We bounced back, but at one point during the pandemic, we hit the bear market. So when an event or something very significant happens fast, that's where the event driven bear market starts coming in.
Yeah. And those tend to be shortest lived
Yep.
and the quickest recovery on those. And,
Yep.
and the depth of them also, we can see that in that first chart there. A structural bear market tends to be much deeper, which makes sense why it would take longer to get to and longer to recover from. Whereas the cyclical, on average, you're looking at about a 30% downside. You're looking at about a 30% correction. Same thing with event driven. So if we are truly in a cyclical bear market here, and everyone's different. I mean, we don't know for certain where this thing is going to bottom out. We don't know for certain when it's going to turn. But I thought it was really interesting too. Do you recollect what they'd said about the like the market reaction versus like the earnings and companies and sort of that timing?
I do not recollect that, but it does, like, as you were getting, the structural bear market is okay when the economy is collapsing.
Mhm.
This obviously you have a larger collapse in this in the stock market and everything. We still have a strong economy going forward, and hopefully that continues going. You still see every restaurant trying to hire jobs, trying to get the
Mhm.
economy going again. So hopefully we're going to stay in the cyclical bear market, and we'll bounce back soon. But you never know, like if we have to slow down faster. It really depends on how we tamper the inflation rate and how the economy grows from that going forward when we continue to rise on the interest rate side of things. So
Yeah. I think the other thing that's interesting too, we talked about this a lot during the pandemic, and I know we've talked about it before, how you can have those huge disconnects between what the market is doing and what's happening in the world
yeah,
around us. Because oftentimes the market is pricing in so many things, and it's usually ahead of what's happening in front of us. And so, and I think it was, and actually yes, it was in a cyclical market. On average, you'll see the market will hit a trough, and then 6 to 9 months later, the earnings per share in companies will hit their trough. And so the market is already projecting out that earnings are going to slow down over the next 12 months, and it's baking that in at the front end. And so I wouldn't be surprised, when we get to the point eventually when the market does turn, that it's going to feel like a bizarro world where we have positive market returns over here, and then we're getting all these horrible earnings reports over here. And those are, kind of oftentimes lagging. The market has already priced that in. And so those are things just to kind of be aware of too. Like things might still feel really rocky even when it does start to turn and we start to get some positive returns instead of.
just like when the Fed is obviously they still continue to think the Fed's going to continue raising interest rates, and when they do that, people are like,
Mhm.
okay, when the Fed raises 75 basis points or whatever for the 10 year, and the market rallies on that, it's because they're maybe expecting more
Right.
of an interest rate than what they actually did.
Yes. Yeah. That's the thing. That's where I think it's so hard to be Jerome Powell, because you have to be careful with every single word, because every single word that comes out of his mouth is setting a new expectation. And if that expectation isn't met exactly where he wants it to be met, then we get the reaction positively or negatively.
Yeah.
So that's a tough position to be in. But all right. Well, I think those are some of the big things that we wanted to make sure to kind of touch on today. Some of the things that we're talking about, some of the things that, questions that we're hearing, just from clients or from people in our, industry network, some of the discussion. So I really thank everybody for tuning in today. And if you had any last minute questions, if you wanted to post those, please feel free. Otherwise, we will be here again next week, next Wednesday, and we'll look forward to just seeing where we're at. You never know where we're going to be. So thank you so much for your time today. And I hope
Have a
you have
good
a
day.